Ever get that feeling like your finances are a stack of plates spinning on sticks?
Yeah.
One little wobble, maybe a surprise bill, a car repair, and you feel like the whole thing could just crash down.
Yeah.
Well, you're definitely not alone. It's actually been shown that over a third of working adults right here in the U.S. are in a pretty similar boat. They couldn't really handle even a moderate financial shock within a month.
Right. And what we're really digging into here is this idea of financial fragility, basically how close someone is to that edge.
Right.
And researchers often measure this in a couple of key ways. Like, could you get your hands on, say, $400 right now if there is an emergency?
Right, like it immediately.
Immediately. And then could you confidently come up with maybe $2,000 within about 30 days if you absolutely had to?
Okay, so two different time frames, two different amounts.
Mhm.
And we've got some pretty interesting insights into this from a couple of studies back in 2015, right?
That's right. The National Financial Capability Study, the NFCS, and the Survey of Household Economics and Decision Making, which is called SHED.
NFCS and SHED.
Got it.
And interestingly, even though they were both looking at, basically the same problem, they came up with slightly different numbers.
Oh,
How different?
Well, the NFCS suggests around 36% of households were financially fragile, while SHED put it a bit higher, closer to 41%.
Right.
oh, okay. So maybe 36% versus 41%. It's in the same ballpark, though.
Exactly. Slight differences in maybe how they asked the questions or who they asked.
Methodology.
Right, the methodology.
Right.
But the big picture is pretty stark.
Mm.
Roughly 4 out of 10 American households are kind of walking this financial tightrope. It's not just a statistical blip. It really points to a widespread vulnerability.
And I think what's really surprising, or maybe counterintuitive, is that this isn't just a problem for people with low incomes, is it?
No, not at all. That's a key finding. It's easy to assume this is only about the lowest income brackets, but these studies show that a significant number of middle-income households are also living pretty close to the edge.
Okay, define middle income here. What kind of range are we talking? So we're looking at households earning between, say, $50,000 and $100,000 a year.
Right.
In the $50,000 to $75,000 range, almost 30% were financially fragile. And even in the $75,000 to $100,000 range, it was around 20%.
Wow, so even nearing 6 figures, 1 in 5 households couldn't quickly handle a shock.
Exactly. It really underlines that financial vulnerability isn't just about how much you earn. Things like lack of savings or high debt levels can create fragility even with what looks like a comfortable salary.
Yeah, it definitely challenges that traditional idea of who's actually financially secure.
Mm-hmm. And historically, when we've tried to understand, poverty and why people struggle financially, there have been sort of two main camps.
Okay.
One idea is that people are basically making rational choices given the limited options they have, adapting logically.
Making the best of a bad situation.
Right. The other idea, sometimes called the culture of poverty, suggests that maybe certain ingrained attitudes or behaviors contribute to their economic hardship.
Okay, so one is circumstance, the other is maybe mindset.
Sort of. But there's a third perspective that's become really powerful for understanding this stuff: behavioral economics.
Ah, yes. We've talked about that before. It blends psychology and economics.
Exactly. It shows us that our financial decisions aren't always purely logical. All sorts of psychological factors, biases, ways our brains work come into play.
Which helps explain maybe why people struggle, even when solutions might seem obvious from the outside. Like, let's talk about small barriers having a big impact.
Yeah, this is absolutely critical. Behavioral economics shows that even tiny hurdles can stop people from taking actions that would clearly benefit them in the long run.
Like opening a bank account. Seems fundamental.
Right. Rationally, having an account is hugely beneficial for managing money. But a surprising number of lower-income folks remain unbanked.
And it's not just about not having money to put in.
Well, that can be part of it, but the behavioral view suggests other things matter just as much, like maybe the bank branch is inconvenient, or the hours don't work, or even just a fear of being treated badly, feeling judged by the staff.
Right, those sort of hassle costs.
Exactly. That's the term behavioral economists use. These psychological or logistical burdens, they can be surprisingly strong barriers. It's kind of like, how hard it can be to stick to a healthy diet or exercise routine, even when you know it's good for you?
Yeah, that little bit of extra effort feels huge sometimes.
Precisely. That small inconvenience can loom larger in the moment than the long-term benefit.
Okay, so for the unbanked, it's not just inconvenience. There are actual costs too, right?
Oh, absolutely. Big costs. They often pay high fees just to cash their paychecks or pay bills. And think about saving. They often rely on informal methods, things like layaway plans or maybe rent-to-own agreements.
Which you called negative interest saving.
Essentially, yeah. Because while they give you access to things, the total cost you end up paying is often significantly higher than if you'd bought it outright after saving up.
Right, you pay a premium for the convenience.
You do. And then there's this concept called mental accounting.
Okay, what's that?
It's how we kind of mentally label and categorize our money. Like, this is rent money, this is grocery money, this is fun money. But without a formal bank account, cash can feel, well, less accounted for, more like just this general pool.
And that makes it easier to spend.
Research suggests yes. Unlabeled, easily accessible cash tends to get spent more freely. It just sort of disappears, making it harder to save overall.
So if these are the behavioral barriers, what does behavioral economics suggest we could do about it? Policy-wise, for banking.
Well, it points to some neat ideas. One is using better defaults.
Defaults.
Yeah, like when someone gets government benefits, instead of defaulting to sending a paper check, which they then have to pay to catch the default, could be direct deposit into a bank account. Make the helpful option the easy automatic one.
Lowering the hassle cost right away. Makes sense. What else?
Another idea is tapping into positive identities, our sense of who we are. Instead of framing things around the stigma of being poor or unbanked, maybe frame opening an account or saving as something a responsible person or a good saver does.
Using psychology to encourage the behavior.
Exactly, linking it to a positive self-image. And there's also the idea of dedicated accounts.
Like earmarking funds?
Sort of, but more formal. Maybe banks or community groups could offer accounts specifically labeled for goals, like a rainy day fund or a fridge fund someone mentioned. That label makes the goal more concrete, maybe harder to dip into for other things.
Interesting. Okay, let's shift gears a bit. Another puzzle is why participation in available social programs is often, well, surprisingly low. People who seem to need help don't always access it.
It really is a paradox, and the traditional explanation often focuses on stigma, right? People feeling ashamed to ask for help.
Yeah, that makes intuitive sense.
And it definitely plays a role, no doubt. But behavioral economics points to those hassle costs, again, being a huge factor.
Hassle costs for applying for benefits.
Oh, absolutely. The application processes can be incredibly difficult. We're talking long, complicated forms, confusing questions. One study found state food stamp applications that were up to 36 pages long.
36 pages. Wow. That's daunting.
Massively daunting, especially if you're already stressed and overwhelmed. And it's not just the length. Sometimes the process itself feels, well, intrusive or demeaning. Things like fingerprinting requirements, warnings about perjury, maybe home visits.
Yeah, that could feel pretty off-putting.
It can trigger negative feelings, maybe reinforce a sense of hopelessness and just make people not want to engage. It's like the system, maybe unintentionally, puts up these barriers.
And then there's just plain old procrastination.
Yes. Just like we put off other annoying tasks, people might delay applying for welfare. Maybe they anticipate it being a long, difficult process with no immediate payoff.
And how we frame it mentally matters too.
Yeah, that's interesting. If you're not currently getting benefits, not applying might feel like just missing out on a potential gain, which feels less bad than actively losing something. So the motivation to act is maybe lower.
Less urgency.
Right. And finally, there's wishful thinking. Someone might think, oh, I'll get a job soon, or things will pick up next month. So they put off applying because they think they won't need it for long.
Okay, so if these are the roadblocks, hassle, procrastination, framing, wishful thinking, what are the policy ideas to get more people enrolled in programs they're eligible for?
Well, the most obvious one is making the process simpler. Shorter forms, clearer language, maybe unified applications for multiple programs, which some states are doing.
Right, apply once for several types of aid.
Exactly. And pre-filled forms, using information the agency already has, can make renewals much easier. Just streamline the whole thing.
Seems like a no-brainer, really.
Yeah.
What about addressing the feel of the process, the negative emotions?
That's crucial too, fostering a more positive, trusting attitude. Some evidence suggests that when people feel trusted and respected by the system, they're more likely to engage. Right now, some programs can feel quite adversarial, like they're focused only on catching fraud.
Finding that balance between accountability and goodwill.
Precisely. Building goodwill could increase take-up and maybe even improve compliance with other program rules like job searching.
You also mentioned that programs are often decentralized. How does that fit in?
Yeah, so states or local offices often run these programs. While that allows for local flexibility, it can also mean huge variations in how easy or hard it is to apply. So maybe alongside federal minimum benefit levels, there should be something like maximum hassle rules.
Huh. Maximum hassle rules. I like that. Basically, stop states from making it too difficult.
Yeah, to prevent local offices from, intentionally or not, discouraging people through just excessive red tape.
This is really fascinating. Okay, let's pivot to another big behavioral factor. Impulsivity.
Yes, impulsivity. That tendency we all have to some degree to act on sudden urges, especially when it comes to buying things or taking on debt.
It's linked to that present bias idea again. Wanting things now.
Exactly. That strong preference for immediate rewards over future consequences. So you might really want that new gadget now, and the future pain of paying off the credit card debt feels distant, less real.
And high impulsivity can actually make financial knowledge less effective.
That's what some really interesting research suggests. Someone might know intellectually that a high-interest payday loan is a terrible idea. But in the moment, the immediate need for cash driven by impulsivity can just override that knowledge.
So there's research looking at financial literacy, impulsivity, and debt levels specifically.
Yes, and the findings are quite striking. Studies show, predictably, that lower financial literacy is linked to having more debt, and higher impulsivity is also linked to having more debt.
Okay, that makes sense.
But here's the twist. When you analyze them together, impulsivity seems to be the main driver. It largely mediates the relationship between financial literacy and debt.
Okay, unpack that. Mediates.
It means that the reason low financial literacy often leads to high debt seems to be because low literacy often goes hand in hand with higher impulsivity. When you statistically account for someone's level of impulsivity, that apparent direct link between financial literacy and debt often disappears.
Wow. So just teaching someone about finance might not be enough if they're highly impulsive. The impulsivity cancels out the benefit of the knowledge.
It seems that way, to a large extent. It's often the less impulsive people who are actually able to apply their financial knowledge effectively to avoid debt. And interestingly, research also finds a negative correlation. More impulsive people tend to score lower on financial literacy tests.
It's like a cycle.
Yeah.
Maybe being focused on the short term makes you less likely to invest in learning for the long term.
Could be. It's a complex interplay.
Yeah.
And of course, we can't ignore how marketing plays into this.
Oh yeah. Limited time offers, checkout displays.
Exactly. So many marketing tactics are designed precisely to trigger that impulsive buying behavior, make you grab it now without thinking too much.
Okay, let's zoom out again. We talked about who's fragile middle-income folks, too. The Living on the Edge report gave a lot more detail on demographics, didn't it?
It did. A really granular look. So income, yes, higher risk below $50,000, but like we said, significant fragility even in middle brackets.
What about age? Is it mostly young people?
Surprisingly, no. It's pretty evenly spread across age groups. There's a slight uptick in the 40-49 range, though.
Why then? Peak earning years for many.
Possibly peak obligations, too. Think about it, mortgages, maybe kids' college savings or childcare costs, still paying off student loans, perhaps. And the report did find that having dependent children in that age group significantly increases fragility.
Right, the financial squeeze. And gender.
Yeah.
You mentioned women are more fragile.
Yes, significantly so. Around 42% of women compared to 29% of men were found to be fragile. But interestingly, being married and being employed seemed to reduce fragility more for women.
And education. Does a degree help?
Generally, yes. More education tends to mean less fragility. But there was a noticeable gap between having a bachelor's degree versus just some college but no degree. The degree seemed to offer more protection.
Even after accounting for income differences.
Yes, suggesting education provides benefits beyond just higher pay, maybe in terms of planning skills or access to networks.
And the report mentioned other factors, too, like ethnicity, marital status.
It did. Rates varied by ethnicity, lowest among Asian individuals, highest among African Americans in that study. Marriage seemed protective. Married people were less likely to be fragile than unmarried. And, as you'd expect, having more children generally increased fragility, and being unemployed increased it dramatically.
Okay, so that's who is fragile. What did the report say were the main causes or drivers?
It really boiled it down to three main things: lack of assets, too much debt, and low financial literacy.
Lack of assets. So not just physical things like a house.
Right. It includes not having basic financial tools like a bank account or a credit card, not having enough insurance, not enough retirement savings. It also means less capacity to borrow money in an emergency.
Okay. And debt, you mentioned specific types.
Yes, medical debt and education debt were highlighted as major contributors. But even things like car loans could make it hard for someone to handle a smaller shock, like that $400 repair bill.
And the third driver, financial literacy itself.
Crucial. The report found literacy significantly lowers the odds of being fragile, and importantly, this was independent of someone's level of education.
So knowing about finance helps, regardless of whether you went to college.
Exactly. And it seemed particularly beneficial for women. Higher financial literacy really helped reduce their chances of being fragile.
So it really paints a picture.
Yeah.
You need the knowledge, you need some assets or savings as a buffer, and you need to manage debt carefully. What happens when people are living in this fragile state? What are the consequences?
Well, they're immediate and long-term. Short-term, it's just this constant struggle, right? Any unexpected expense, a parking ticket, a broken appliance can become a full-blown crisis, potentially starting a downward spiral.
Yeah, domino effect.
Exactly. And long-term, it really undermines planning for the future, especially retirement. People living on the edge just don't have the bandwidth or the resources to save for their later years. Their future security is really jeopardized.
Which brings us right back to that core challenge.
Hmm.
Saving money. Even when we know we should, it just feels so hard sometimes. Is there like a brain science reason for that?
There absolutely is. We touched on present bias, but the neuroscience is pretty cool. Brain scans, fMRI studies show that when we think about our future selves,
Yeah.
there's less activity in a specific part of the brain, the medial prefrontal cortex, the MPFC. That's the part that's really active when we think about our current selves.
So our brain kind of sees future me as someone else, a stranger almost.
That's a great way to put it. It processes information about the future self more like it processes information about another person. This neurological disconnect makes it harder to really feel the needs of that future self and make sacrifices now for their benefit.
Wow. No wonder saving feels like pulling teeth sometimes. That future reward just doesn't feel as real or urgent as what I want right now.
Precisely. That's the power of present bias rooted in how our brains are wired.
Okay, so if our brains are kind of working against us here, are there ways to, I don't know, trick our minds into being better savers?
Yes, we can use behavioral nudges on ourselves. One really interesting approach is making that future self feel more real, more connected to our present self.
How do you do that?
Well, studies have shown things like using those aging apps, where you see a projection of what you might look like older. Looking at that image can actually increase people's motivation to save for retirement. It makes the future less abstract.
Huh. So visualizing old me makes me want to take care of old me. That's fascinating. What else works?
Making saving automatic is probably the single most powerful strategy. Take the decision out of your hands each payday.
Like direct deposit into a separate savings account.
Exactly. Or using commitment accounts where there's a penalty if you withdraw early. It creates friction against dipping into savings impulsively. Apps that automate savings, like rounding up purchases or sweeping small amounts, work on the same principle.
Setting it and forgetting it.
Pretty much. And then there's flipping your whole budget approach. Instead of saving what's left over after spending, try reverse budgeting.
Save first, then spend what remains.
Exactly. Prioritize your savings goal. Warren Buffett has famously said, do not save what is left after spending. Instead, spend what is left after saving. It forces you to treat saving as a non-negotiable bill.
That's a good mindset shift. Yeah, we also have to acknowledge the world around us, right? Social pressures, social media.
Oh, absolutely. Those external factors are huge. We see these curated, perfect lifestyles online, and it can create this unconscious pressure to keep up, to spend more, to fit in or project a certain image.
The keeping up with the Joneses effect. Turbocharged by Instagram.
You got it. And easy credit makes it possible to spend beyond our means to chase that image. It's really important to be aware of that pressure and consciously separate your actual needs and wants from those driven by social comparison, which leads directly to lifestyle inflation.
Right, the tendency to spend more just because you start earning more. Your expenses rise to meet your income.
And again, even someone like Warren Buffett warns strongly against this. He famously still lives in a relatively modest house he bought ages ago.
Drives a regular car.
Right.
Right.
His point is that every dollar spent on an unnecessary upgrade, a fancier car, a bigger house you don't need, is a dollar that isn't being invested in growing for your future self.
It's a powerful point. Focus on the long game. I heard people on Reddit were sharing tips on how they fight lifestyle inflation.
Yeah, some really practical stuff came out of discussions like that. A big theme was consciously surrounding yourself with people who are also mindful about money. Having a partner who's on the same page financially is huge too. Communication is key.
Makes sense. Your social environment matters. What other tips?
Things like practicing delayed gratification, like wait 24 hours or even a week before making a non-essential purchase. See if you still want it.
Let the impulse cool down.
Exactly. Also, tracking your spending meticulously so you know where the money is actually going.
Hmm.
Using separate accounts for bills versus fun money. Setting a firm budget for once. Actively avoiding sales unless it's for something you genuinely needed anyway.
Just being more intentional about it all.
Right. And someone shared a great quote. No one is as impressed with your possessions as you are.
Ooh, that hits home.
Yeah.
Stop buying things to impress people who probably aren't paying that much attention anyway.
Precisely. Focus on your own goals. That emergency fund, paying down debt, saving for retirement, those are the things that actually build security, not the fancy watch or the latest phone.
So, okay, bring this all together as we wrap up this deep dive.
Yeah.
It's clear financial fragility is, well, it's really widespread. It hits people across income levels,
Yeah.
across age groups, and it's not just about income. It's deeply tied to these psychological factors, impulsivity, that present bias, how we think about our future selves, and then layered on top are social pressures and this tendency towards lifestyle inflation.
That sums it up well. And I think the crucial takeaway for you listening is that getting better financially isn't just about learning more finance facts, although that definitely helps. It's also about understanding your own mind, your own behavioral quirks, and the environment you're making decisions in.
Right. Self-awareness is key. So maybe the final thought for you to mull over is this. How can understanding the psychology of your own financial self be that critical first step toward building more resilience, a more secure future? What's maybe one small behaviorally smart change you could try making starting today that might put you on a stronger path?